And good afternoon or good morning to each one of you on the call today, depending on where you're located today. I really do appreciate the opportunity to talk on this subject. It's something that I feel pretty passionately about, and hopefully it will be of value. The question that we want to address today is on the screen: what is the business really worth? What is the business really worth? And the answer to that question comes from different angles, from different perspectives, depending on who you are in the conversation. So what I will attempt to do over the next hour is to address the problem of these different points of view. What is that business really worth? Means different things to different people. Then we'll put a process in place, and we'll talk about the recipe that we will follow, or that business valuation professionals follow, to answer that question. What's the business really worth? There are certain steps that we follow and go through. And then lastly, we'll talk about the people who are qualified and experienced to deal with in answering the question. So I just love a good alliteration: the problem, the process, and the people. So it's easy for me to remember, so we will work our way through the answers to the question, what is the business really worth? What are the odds that you will encounter this question? And I know each one of us come from different perspectives, and our professional backgrounds are different, and we are doing different things at the present time. And as Laura shared with you, I spent a number of years in the business brokerage arena, merger and acquisition field, and I dealt with that question for quite a few years. And it was not unusual to sit down with a prospective seller of his business. Well, Mr. Business Owner, what do you think your business is worth? Kind of one of the leading questions that we would ask, and always got a bit amused by the answers that would come back. Some of them were very precise, very exacting, knew exactly what they wanted out of their business in terms of income. Others, as you can imagine, did not have a clue. But probably the best one that I got was one of the prospects answered the question in the following way. He said, well, once I sell the business, my wife and I intend to travel, and we're going to buy a large motorhome and go coast to coast, and all we're going to do is travel, and it's going to cost me $350,000 to buy that motorhome. So that's what my business is worth, $350,000. Obviously, he did not have a clue as to the real process. Yes, he had a goal in mind, but he was not the only one that was trying to answer that question. What's the business really worth? It was the buyers, the prospects that will look at his business that would have an impact or a say on how that question was answered for him specifically. So I dealt with this question as a business broker, and then the last 3 years as the general manager of the International Society of Business Appraisers. That's what we focus on a day-to-day basis. We have a growing list of members of our association, and we focus our education on that question. What's a business really worth? We'll look at some other associations that do similar education curriculum or offer similar education curriculum as we do at the ISBA, but we are one of the few associations that focuses on small business. That business that's found on Main Street, not on Wall Street, but down on Main Street where mom and pop live. I know, as I said, we all come from different perspectives, but I think it would be helpful at the outset of this conversation, one way as it might be, is to define, what does small really mean? Sometimes we have the wrong idea when someone says, well, I own a small business. Well, it's a hot dog stand or something very small in nature. Well, if we go to our friends over at the Small Business Administration and Google their website, what you will find is that their definition of small is any manufacturing business with less than 500 employees. Or if it's a non-manufacturing business, we'll have more than $7.5 million in annual revenue. I don't know about you, but if I had to sign 499 paychecks every Friday, I would probably think I don't own a small business. In fact, there are 28 million small businesses in the United States at the present time that fit that criteria. 50% of the working population, our neighbors, our family members, 50% of us are working in the small business arena. So my point is that the odds are pretty strong, or pretty high, I think, that you may be dealing with someone in your practice that owns, operates, has a piece of a small business. The conversation that we're going to have today, it's going to be focused on Main Street, not on Wall Street. So if you tuned in today to hear me discuss about CAPM, regression analysis, unlevered betas, and mid-year conventions, I'm not going to go there because, as I said, Main Street is the focus of the International Society of Business Appraisers. As a kid growing up, we weren't allowed to use the S word at my home. We couldn't say keep it simple, stupid. So as my dad would say, keep it simple, son. That's the approach I'm going to take today, is to lay out for us the process dealing with the smaller type of businesses. Now, the approaches and processes that I'm going to talk about are applicable from Main Street to Wall Street, just in different ways. So as I said, the focus of the ISBA is on those businesses that are smaller in nature, but 500 employees in my book is not always small. You may be dealing with a client or someone, a business owner, that says, well, I don't need to have a business valuation done. I have already gone through that exercise. I have a report, it's written, it was done by a credentialed certified appraiser, so no need to go further. I already know the value of my business. Well, at the outset here, as we're dealing with this problem of what's my business worth, it can be worth different numbers for different purposes. In other words, one size does not fit all. Just because a business valuation report has been written does not mean that that answer will be the same for another reason. As you might look at that report that your client or prospect would give to you, you may notice inside that report, if it's written by a credentialed certified appraiser, there are some very specific items outlined. In one at the outset will be, what's the intended use of this report? So if we're trying to deal with a divorce situation, that will be very specifically stated in the report. If the report was written for litigation purposes, for tax planning purposes, that function or that use will be in the report, as well as the intended users who have the authority to view the report, to use the report for their purpose, will be specified in the report as well. Well, why is the use specified and the users? Well, it's for the protection of the author of that report, the evaluator who prepared that report. There are liability issues that we have to be aware of as we're writing these business valuation reports, and we want to make sure that the reader of the report knows our approach, knows what the use that we were targeting, and who was allowed to use our report. Now, granted, if someone is outlined in the report as an intended user and they share it for other purposes, that's something that the author cannot control. But my point is that when you're looking at a business valuation report, there are some very specific limitations that you will find in that report. So be aware of that. If a prospect says, I don't need to go through that expense or that exercise of having it valued now, I've already had that problem taken care of. Beware of those limitations. We also need to be mindful of standards that are used when the report is written. In talking about this process of valuing the business, there are standards that appraisers must adhere to. The ISBA, or that's the initials for the International Society of Business Appraisers, we follow USPAP. Many of you may be familiar with USPAP, but if not, it's the acronym that stands for Uniform Standards of Professional Appraisal Practice. USPAP was a product of the savings and loan crisis that some of us remember that happened back in the mid-1980s. The Congress went into session and founded legislation which dealt with USPAP. The Appraisal Foundation was given birth to, and the Appraisal Foundation, their focus, their function is to write rules and regulations that govern the appraisal world. Now, appraisal world can mean real property, it can mean personal property, it can mean intangible things, it can mean machinery and equipment, artwork, jewelry, and there are different standards within USPAP that govern what we as appraisers do. So every group, association such as ours, the ISBA, every group or association has different standards that they follow. For instance, the AICPA, the governing body of the Certified Public Accountant profession, they have a set of standards that govern how their members should write business valuation reports. So it's not as if we as valuators go out and just put a report together haphazardly. No, there are standards, there are regulations that we are to follow to write a valid report. And of course, we could talk for quite a while about international standards that are out there, and they can be quite different than those that we see here domestically. Other reasons why a client or prospect may have had a business valuation are, as you can see on the screen here, these are just 6 of some that can be out of a wide array of reasons, but estate planning purposes, if someone is gifting assets away, whether it's land, real property, or if it's personal property, the IRS wants to know, who determined the value of that business that you're gifting, if that's the case. Shareholder disputes. Logically, if there are 2, 3, 4 owners of a business, they all have different points of view, and if the business ownership team does not work well, they may enter into litigation, and then, well, we need to determine what's our business really worth, and what's my 36.5% worth of the total piece of that pie. So merger and acquisitions, as I said, that's the world that I came from. And you can imagine, if you've ever bought or sold a business, there can be a wide disparity between what the seller thinks his business is worth and what that buyer or investor might think that it's worth. So at that point in time, then an independent person or the independent appraiser is retained to solve that issue or provide a defensible estimate of value. Some of you may be familiar with ESOPs. We as appraisers like these requirements because an ESOP plan must be updated. The business must be valued on an annual basis. So that's somewhat like an annual annuity, if I can call it that, for the business valuation professional. If he does a good job every year, that plan needs to be, or that business rather, needs to be valued, and the ESOP plan needs to be updated. And then the last reason that I'll address here is for the Small Business Administration, and that's really kind of the entry point for many of us who've gotten into the business appraisal world. SBA loans require that the business be valued if the purchase price is above a certain dollar amount. Now, the SBA, does go on and stipulates that only certain people can write business valuation reports for that purpose. In other words, there is a section, I think it's in the current SOP or standard operating procedure that the SBA is following. I think it's found on page 138. It's a listing of qualified sources. In other words, the appraiser must have a certain credential or credentials behind his name in order to write a business valuation report used for SBA lending purposes. I'm happy to report that the ISBA, our credential, the Business Certified Appraiser certification, has been recognized by the SBA for that specific purpose of being able to value a business, write a valuation report that would be accepted by the Small Business Administration. But you can see that there are a wide variety of reasons why a business could be valued. So as you're reading that or reading a business valuation report, be aware of that. In dealing with the process, we need to agree, or at least understand, what does value mean? Google the word. It's a function of the ability of the business to generate income for the owner or owners. So that's really what we're focusing on, is trying to determine how much income or lack thereof does this business produce. And if the business is not producing income, then we're looking at other approaches to value. So that's really the focus of this entire conversation that we're having, is what's the ability of this business to generate income that can be used for salaries, can be used for dividends, can be used for a wide variety of descriptive terms. But that's what the appraiser focuses on, which leads us to talk for just a second about the advocacy of the appraiser. Again, going back to USPAP that I talked about, the Uniform Standards for Professional Appraisal Practice, within those standards, we are cautioned as appraisers not to take sides, so to speak. In other words, we are to be an advocate for the value. We are to be an advocate for the number that we arrive at that can be attributed to this business to generate income into the future. So we are cautioned within USPAP not to take sides, if you will. Yes, we may end up in the courtroom and we may be an expert witness for one side or the other, but you know, when we're sitting in that witness chair, we're trying to, or we're doing the very best that we can to outline the process, the procedures and the approaches that we use to determine value. And to take this value discussion just a little bit further, we need to talk about the premise of value, or said in other words, what is the standard of value that we are trying to determine? And it really can be broken into 3 different levels. And let me start here with the bottom bullet point, and just to help us understand that the business valuation process, it's a forward-looking exercise. Imagine with me, if you will, that we're at a June the 21st, 2016. We're trying to value the business as of today. That's our effective date of this valuation. What we expect, or we would anticipate, under the first scenario, the going concern scenario, that the business will continue on doing what it's presently doing. For instance, if it's a manufacturing environment and it's building widgets, it's going to continue to produce widgets on out into the future. And the appraiser will take the forward-looking position, and he'll look down the road 3 years, 5 years, 7 years, whatever the forecast or projection might be best used for in terms of time. He'll look down the road to determine sales growth, expenses, what will they do, and in cooperation with the management or ownership of the business, we'll project out what future income might be. Then we'll take that future income and we'll discount that back to today's dollar. In other words, what's a dollar 5 years from now worth in today's economy? So it's a forward-looking exercise that the evaluator will go through. So if it's a going concern, that's our premise of value. We expect that things will continue on as they are. But not every business and every situation falls in that category. There might be an orderly disposal of the business that is going to be taking place. In other words, let's just say that it is a divorce. And once the prevailing party or the party that ends up with the business says, well, I don't want the business any longer, within 2 months, 3 months, or 6 months, the business will be closed. Yes, it's going to continue in operation for the short term, but eventually the doors will be closed. We're going to find the best buyer that we possibly can, or we may go out of business totally, but that takes away that projection looking down the road 5 years to project out income. If we are told that the business is going to be closed, that's one premise of value that the appraiser will take in mind. He'll take those facts into consideration in determining his value under an orderly disposal methodology. And the last case would be a liquidation scenario. That would be, today is Tuesday, we're going to lock the doors on Saturday. We're going to have an auction. We're going out of business immediately. In other words, we're not going to look for the best buyer. We're shutting the doors. So again, obviously, we don't have the ability then to project out 5 years or 7 years. Income won't be there. You have told me that my scenario or my standard of value is that the doors will be closed immediately. So then we're going to take a different stance. And what else are we going to be looking at to determine value? Well, it's going to be the value of the machinery and the equipment and the inventory, perhaps the real estate. Our premise of value will be totally different. So I start to share these things with you as advisors. When you're dealing with clients, start to make a mental list about those pieces of, or those things that you need to bring to your client's mind. If the business is sold, we'll continue on. There'll be some other items we'll look at here toward the end of the presentation that are very practical in nature. What things, what reports, what financial statements, what tax returns does the business owner need to be ready to produce? Getting a bit ahead of myself here, but the premise of value is an important issue that the appraisor will need to know. Another piece of information that you need to be aware of when you're looking at a business valuation report and in judging what should be in that report. Let's talk for just a minute about Revenue Ruling 5960. Back in 1959, the 60th revenue ruling from the IRS on that year came out with what, this is my term, it's kind of the biblical guideline for business valuation. That revenue ruling, which is still in play today, still is held in very high esteem by, I would think, all appraisers that have been much education in this profession will know about Revenue Ruling 5960. There are 8 components that the IRS suggested should be in a valid business appraisal report. And let me just quickly step through these 8 pieces because they help frame the report and what it should contain. First is the nature of the business, kind of the basics of what does this business really do? What industry is it in? When was it founded? Who are the owners? What hours of operation? How many employees? It's kind of the, I don't know, probably the goodies of the business, if you want to use that term. It's kind of what's the business really about? And so those facts need to be in the report. Then Revenue Ruling 5960 stipulates that the economy needs to be addressed, and it needs to, Revenue Ruling doesn't use this term, but it's the funnel approach that we need to keep in mind. The report needs to talk about the economy on the broad scale, maybe international facts, national facts, draw it down to regional, down to the city demographics, city economic conditions where the business is located. Funneling those items or those pieces of information down to the subject itself. How does the economy and the regional economy really affect the subject? A good valuation report should not just be a cut and paste of much economic data. Yes, that's good information to have, but then it should really summarize that section by focusing on how does this impact value of the subject. The appraiser should make comments. Well, I'm concerned about interest rates will be rising. The economy is unstable right now, so I've taken that into consideration when I'm determining the value. So the economic conditions need to be addressed. Then the book value of the stock needs to be spoken to. And the book value is really kind of the financial section of the business. I'm sorry, of the financial section that reports the activities of the business, the balance sheet, the income statement. And typically we like to see a minimum of 3 years of history. 5 years is probably predominant, you will find. But the book value of the stock is determined by the balance sheet, and the appraiser should address that. Now, the book value of assets, as we'll look here in just a minute, can be totally different than the market value of those assets. So the balance sheet will be given some considerable consideration. So the book value is a big topic that we'll look at. The earnings capacity of the business. This is where we drill down into the income statement and what are the profits of the business, and ongoing, what is the ability of that business to continue to generate cash flow. And then dividend paying capacity. Now, dividends are those funds that are left after all the expenses of operation have been taken care of, capital items have been replaced, repaired, or new equipment has been purchased, though earnings have to be plowed back into the business if it's a capital intensive operation. Then whatever is left over, that's what would be paid out in dividends to the shareholders. And so the Revenue Ruling 5960 stipulates that fact needs to be addressed. And then the intangible value of a business. Sometimes that can be huge, or it can be very small depending on the type of operation. Intangibles, as you might know, would include those things such as copyright, that customer list, that logo, that trade name. Apple Computer, just the word Apple and its logo, that has a tremendous value. It's intangible. Can't really reach out and I can touch the logo of Apple, but it's that intangible value that needs to be spoken to. And then the next to the last item here on our screen is sale of company stock. That's one way that we can get an indicator of value, is by looking in the recent past of the company. Did other stock of this same company change hands? Did someone invest in the company? Did they buy 20% of the stock? And if so, how was the value determined at that point in time? And then lastly, Revenue Ruling 5960 directs us to look at the market price of similar stock or similar operations. In other words, I guess the best way to describe that, and we'll look at the market approach here in just a minute, is if I'm going to list my home for sale, I have a 3-bedroom, 2-bath brick home, and my neighbors down the street sold their home 6 months ago, 3-bed, 2-bath, that's somewhat of a good indicator of what value my current home might have. So we do the same thing in valuing businesses, is that we look at the sale of stock of similar businesses, and we'll put some limitations on that. But Revenue Ruling 5960, that's big. That's big in our profession. The facts, these 8 items, need to be addressed in any business valuation report. Big picture, in terms of the approaches to value, can be said in 3 ways. There are 3 approaches that need to be spoken to in just about every report: the cost approach, market approach, and income approach. They each will have different methodologies that will be used. Each one of those 3 approaches may determine a different value or different number for the business. Then it's up to the judgment of the appraiser to draw these facts together out of the different approaches to determine one final value. And let's step through those real quickly. The cost approach or the balance sheet approach. And again, these are things that you might want to start to think about as you're dealing with your clients or business owner. These are questions that the business appraiser will ask. What about hidden assets? What about things that are not on the balance sheet, which are key or are critical to the operation of the business? For example, maybe due to an accounting oversight, there's a truck has been purchased. It is an operation. It's key to the health and survival of our business, but it's an asset that doesn't show up anywhere. Well, that can add to value, and the business appraiser we'll make adjustments to the balance sheet, and we'll talk about those in just a second. Well, in fact, we're going to do that right now. Restatement of the balance sheet is a process that comes into play. The questions that the appraiser will ask during the management interview, during phone calls, during the exchange of emails from those who know the business intimately, he'll then develop an adjusted balance sheet. For instance, he'll make a comment within his report about fully depreciated assets. On the books of the business, the assets may be old enough that they are fully depreciated off. Simply said, our good friends over at the Internal Revenue Service, they allow us to annually write off or deduct the loss in value of our assets, depending upon the class of that equipment or that vehicle, whether it's a 3-year, 2-year, 7-year, 10-year depreciation write-off. The IRS has schedules that are followed to help us determine how that asset becomes worth a little bit less every year. So on the books, that truck may be completely written off. It may have zero value according to our balance sheet, but in reality, it's still driving up and down the road every day making deliveries. It's still very functional. It still has life in it, so to speak. So the appraiser will make adjustments on the adjusted balance sheet within the report to recognize those assets that are still in operation. On the other side of the equation on the balance sheet are the liabilities. In the conversation that will take place, are there situations, circumstances going on within the life of the business that have not made it to the liability section yet? For example, do we know that there is an employee lawsuit pending? Are we having a legal dispute with a customer or a supplier? Maybe those facts have not made it into the numbers, so to speak, but the appraiser will take that into account. Because remember, we talked about projecting out into the future what our income will be. Well, if we have to settle a sizable lawsuit on down the road, that will impact our earnings, and the appraiser will need to make adjustments for that. Last two items get a bit personal in nature, and we make no apologies for the questions that we ask in the business valuation world, but some of them are just that, because we have to ask some uncomfortable questions from time to time. For instance, are there personal assets that the business owns that are on the balance sheet that are totally non-business related? For example, I'm speaking with you today from Dallas, Texas. It is not unusual for people in this part of the state to have a vacation home down on South Padre Island. You know, a decent day's drive to get there, but it's a vacation spot. It's a nice piece of property to have. Well, the business owner may decide, well, I'm going to buy that vacation home down on the coast. I'm going to let the business put up the cash or sign the note, and we'll hold that as a business asset. And I'm going to have that vacation home for my best clients to use, my best customers. They can drive down there every weekend if they want to. I'll give that to them. That'll build customer loyalty. That'll tie them closer to me. That's a good thought, but in reality, what I see happening, and I'm sorry if I'm a bit jaded here, but looking back over 17 years of dealing with business owners, very rarely did I see that happen. Yes, they would own the business home, but only he and the wife and the kids and maybe the in-laws would go to the coast and enjoy that business-owned asset. Customers never went there. So in reality, that was a personal asset and not something that would be part of the business operation. So we as business valuators get a little sticky in that area, and we'll make some adjustments on the balance sheet to adjust those items off. And the last item here, the last bullet point, shareholder loans in advances. We take that into consideration. For instance, let's say a business is operating and it's starved for cash. We need to buy a new vehicle, but there's just not enough cash in the bank. We're totally maxed out down at our credit limit at the bank, and we can't borrow any more money. Well, the owner, the shareholder, may just inject cash into the business as a loan. Well, is that loan really recognized properly on the balance sheet as a liability? Is it paying interest? Is there an actual note written that specifies that? And then on the other side of that equation is the owner or business operator may say, well, I don't want to pay any more payroll taxes. I'm just going to write myself an advance check. I need to buy something for my personal family, and I need a chunk of cash to do that, so I'm just going to advance myself, and is that correctly reflected in the financial statements of the business? So the balance sheet can be one of those areas. It gets a little bit touchy sometimes, but the business appraiser needs to ask those questions. So let's look at the market approach. And to me, this is really, I think, the best approach to use when valuing a business. In other words, if I have a widget manufacturing company, what have other widget manufacturing companies recently sold for? Yes, as you probably know, there are databases that capture that kind of information where I can go out and I can find those comparative transactions, and I build a database of similar comps that I have found, and I then start to do some comparisons. Two key points is that we look at sales price of the other companies that have sold, the other comparables that we have found. What did they sell for in relation to their annual earnings? Or what did they sell for as a multiple of those earnings? So those are the top line and the bottom line are the two key points that we'll use as comparison purposes. And sometimes we can, and I know I'm just coming back to bite me a bit here, but we're talking on Main Street here. There is chances sometimes where we can go out and compare mom and pop's business on Main Street to publicly traded companies to get some comparative data there as well. What you also might want to be aware of are those rules of thumb that are available. And part of your discussion is you need to get a general idea what this business might be worth. We can start to apply rules of thumb. The Business Reference Guide is a great tool, authored by Tom West, well known in the business brokerage and merger and acquisition world. He's been producing that reference guide for about 26 years now. So it's got a big section, wide array of industries, wide array of franchises, business types, where you can start to get some rules of thumb. We as business valuators, we use those rules of thumb just to get us in the ballpark, but that's not what we build our report on, not that rule of thumb. And then lastly, I have what I call the 13th T discussion, which is really not worth a great deal, but I've had clients try it on me before. I'm not a big golfer, but those of you who are, you start out the front nine with 2 or 3 guys that you know, and maybe a stranger or two's added to your foursome, and you chit-chat as you're waiting for the tee box and on the putting green, and then the turn of the 9th hole, you stop for lunch and you get a little more familiar. About the 13th tee is when all inhibitions really seem to fall away, and you start to brag a little bit. And someone might say, well, I just sold my business and I got 6 times annual revenues, or I sold for 13 times earnings. I would leave those kinds of conversations on the 13th green, or 13th tee rather, because they're not even good enough to be what I'll call a rule of thumb. The third approach, the income approach. And we could spend the rest of the afternoon and probably into next week talking about this approach in itself. Just the definitions of what is income, EBITDA, EBIT, net free cash flow. Books have been written about the income approach. But just to step aside for just a minute and to give you a cautionary point, again, going back to my business brokerage career, you'd ask that question of a business owner. He'd hand you his tax return, the question being, what are sales? He'd hand you his tax return. You'd study those documents, and then he'd kind of wink and lean over, and under his breath he'd say, but there's really another $400,000 in cash that I take out of the business. I don't report that, but it's really there. Trust me. That needs to be added to value. I had an old business broker tell me one time that if a business owner will lie to the Internal Revenue Service over something that would cause him prison time, perhaps, what else will he lie to me about? So let me just say that we as valuators, we take the tax return and the financial statements. That's what we use. We don't give credibility to unreported cash. So bear that in mind if you're dealing with a client or someone that is in that type of business, how that will probably be treated. And then lastly, in conclusion about the income approach, we need to know that we as valuators, we want to know all those unusual events that have taken place. What's happened in the recent history that may be what we call a one-time non-recurring event. We go through what we call a normalization process. That legal fee that you had to pay for $200,000 last year to settle a lawsuit with an employee, that doesn't happen every year most likely. Or let's say that a tornado went through your town and took out your manufacturing plant or damaged the roof, and you lost production for 2 weeks, which impacted sales that month. You know, hopefully a tornado won't hit every year, but it's those non-recurring events that we need to make adjustments for to normalize earnings. So the income approach, the cost approach, and the market approach help us kind of put the bow on this process, if you will. And again, the education piece that we give, that I'm walking you through today, the education component of our association, we take 6 days to cover what I've just spent about 20 minutes on. So there is much more detail here, obviously, that we're not covering today. But you need to know the people, the problem, what is the business really worth, the process, we've touched on some of the high points, and who are the people that can help you answer this question. In our opinion, it can be boiled down to initials, credentials that are behind the person's name. And I've got on the screen here 4 of the 5 or 6 associations that are out in the profession that you need to know of, because as you're judging the validity of the report or the expertise of the appraiser, those credentials mean something. For instance, the International Society of Business Appraisers, we have our credentials, the BCA, Business Certified Appraiser. Institute of Business Appraisers, an older organization, their CBA. The AICPA, available only to certified public accountants, they get an ABV, accredited in business valuation. And let me stop there for just a second to talk about CPAs. I love them, I'm not going to throw anybody under the bus. But if I have a problem with my foot, let's say, I need to go to the doctor. Well, I look to a specific doctor. I go to a podiatrist. I don't go to an eye doctor. I want my foot repaired. What's wrong with my big toe? Same thing can be, analogy can be applied to a CPA. They might be great at tax work or valuing you know, other pieces of that business, but to write a complete business valuation report, that does take a specialization, and the ABV is something that you need to be aware of, because most of us know a CPA or we deal with them, but I would caution you to make sure that they are accredited and have the ABV. And then the ASA is what I'll call the granddaddy of the profession, the most difficult credential to get, and if someone has an ASA in business valuation, they've worked hard to attain that. So those are just some of the types of experts with the initials that you will encounter in this profession. But just to chase this rabbit, if you will, just a little bit further about the expert, it's really important for you to know the experience of the appraiser. Obviously, we all have to start somewhere. We don't get into a profession being experienced. It's something that we develop over time. But in talking about divorce and evaluation reports that are written for that purpose, there's some real specialization that needs to come into play there. So the question that you want to ask the appraiser, have you had experience in writing reports for divorce purposes, because those even go to, let's set Revenue Ruling 5960 aside for just a minute. There are several states that have specific regulations about the reports dealing with divorce. You remember we talked about the premise of value or standard of value. Some courts, even within those states, can stipulate what standard of value must be written about in that appraisal report. So my point is, not only do you want to have a certified appraiser, but you want to deal with someone that has expertise in the arena of divorce and who understands the geographic stipulations that he might encounter, he or she may encounter. And then, of course, someone that has litigation or courtroom experience would be good to know as well. Someone that's not afraid to sit in the witness chair and to talk about their process of arriving at the value. Here in the last couple of minutes, let's just talk about the process that you will encounter as you're dealing with these experts. First, there's going to be an engagement agreement once you have determined that this person will be your choice in experts. An engagement agreement will be signed between the appraiser and the client. A request for documents will be produced, and we'll look at that at the next slide. Then once those documents have been produced and reviewed by the appraiser, there will be a time, date, specific hour when the management interview will take place. In other words, most of the time the appraiser wants to go on site and do a site visit. He needs to understand what the business is about. Now, I do know that geography does come into play sometimes, and a site visit is not always possible, but the management interview is fairly paramount into what we do, and not just a 5-minute conversation. It can be several hours in length, depending upon the type of, on the expertise of the appraiser. And then the report will be produced, report will be delivered. How long does all of this take? Well, there's no formula. USPAP doesn't stipulate that and give us so many hours and days to write a report. It depends on a couple things. One is the workload of the appraiser and the normal time of production of a valuation report. I typically see that for anywhere from 2 to 4 weeks. But that's a question that you need to ask up front is of the appraiser. How long will it take you to write the report? What's your current workload like? We all have different things on our to-do list, and most of us, I think, as far as valuators are concerned, will be right up front and tell you, well, I'm 6 weeks away before I could even begin to work on the report. And in conclusion here, working with the expert, the request for documents, what's he going to look for? What do you as an advisor need to tell your client to have prepared? 3 to 5 years of tax returns, 3 to 5 years of financial statements, accounts payable, accounts receivable, aging reports. And let me talk about the last item for just a second. I think most of the rest of them are a bit should be self-explanatory. Customer analysis. Think about the value of a business that only has one customer. For instance, if I'm a distributor and all I sell to is Walmart, we as business evaluators, we don't like that, to be honest with you. That will have a big impact on value, because what happens if Walmart wakes up one day, if they ever go to sleep, but Walmart decides, we don't want to do business with you any longer, we can buy it cheaper from another supplier. You've got 10 days notice, we'll no longer be ordering from you. So think of the value of that business when Walmart goes out the door, so to speak. So this in a nutshell is a request for documents that you could expect from most appraisers. It's going to vary from appraiser to appraiser, but these are the high points that most of us will be looking for. In just a second, we're going to throw open for questions, but in the event that you may say, gosh, I really like what he talked about today, I want to be one of those. I obviously can't see your hand raising right now, but if you wanted to send me an email, I'd love to talk with you more about the International Society of Business Appraisers, our 6-day class that we offer. We take the approach, as I said, that we're dealing on Main Street with a larger number of prospects that do need our services. We do incorporate the use of valuation software in the classroom. That is a bit different from some of the other associations that you might find out there. And typically what we're seeing right now is that once a student starts his education process with us, he can be usually, and everyone's a little different, but the average is about a 2-month time to complete the credentialing process. We are just like the other associations in the fact that classroom time is required, a test is required, and then a demonstration report must be written by the candidate and reviewed by a group of peers before the credential can be designated or given to the member. So let me invite back in Laura. If there's any questions that have come in, I'll be glad to answer those here in the last 5 to 10 minutes, and I'll leave up my contact information. Would love to take your phone call or your emails about anything that I may not have touched on clearly enough today, or any other questions that you may have. So Laura, any questions, please?
Yes, we did get a couple of questions. Greg asks, is dividend paying capacity important for businesses 100% owned by one person?
Depends on the type of entity that is there. If the business is not incorporated, for instance, if the business is operating as a sole proprietorship, or well, let's talk about sole proprietorship, then no, the dividend paying capacity would not be addressed. Where that does come into play would be for a sub-S chapter corporation or a C corporation, those types of entities that do have shareholders that are expecting a return on their investment. You know, if I own General Motors stock, I like it when they send me a dividend check. Small C corporation, I'm sorry, a small S corporation where just my wife and I are the shareholders, we may not pay out our dividend to ourselves. So Revenue Ruling 5960 just says that we need to talk about the dividend paying capacity, which really boils down to what's left over after we've paid all the expenses of operation, after we have made our capital expenditures to keep our equipment updated and current, what then is left over to be paid out in dividends. And sometimes, maybe the thrust of Greg's question is that there may not be anything left. You know, all of the investment in replacement of capital equipment may take up the excess cash that's there. So the point being is that Revenue Ruling 5960 tells the evaluator he needs to address that point, whether that's a good thing or a bad thing. We just need to discuss it in the report.
Alrighty. Russell, how do you value a business with no income?
A little more difficult, but it does leave us with two approaches to address. If there's no income, and I would assume income would be the bottom line that the question means, not the top line, but we can do two things. One is to look at the cost approach or balance sheet approach, and the value then could be determined perhaps on what's the value of the tangible assets. Maybe the business is asset intensive, has a large amount of machinery and equipment, and that's all that there is to value. So we would value the business based on the value of those assets less the liabilities that need to be paid off. We can also take the market approach, and we can compare the top line. For instance, if my widget manufacturing business produces $1 million a year in revenue, but I've got $1.001 million in expenses, I'm not profitable, I've lost $1 for the year, but yet I can go out into the marketplace and I can search databases to find other widget manufacturers that have sold, and what did they sell for as in relation to their top line. For instance, in the widget manufacturing environment, we might find that rule of thumb is that widget manufacturers sell for 30% of top line revenue. So that gives me one one benchmark I can use to determine value for that business that has no income. Then then the valuator or the appraiser will weight his approaches. He'll weight the cost approach, what are the value of the net assets. Then he'll perhaps weight the market approach just based on the limited data that he might find to arrive at his value. So yes, you can arrive at a value for a business that is not profitable or has no income.
All right, I think we have time for one more. Teresa asks, how would you appraise a professional business, for example, a CPA firm or attorney firm?
Great question, because we do, within our association, we have people who specialize in those fields. The longer I'm in this, the more I find people who specialize in different industries, and they're very good at what they do. But to get to the question, you can do somewhat the rule of thumb approach. In other words, back in the day, and this goes way back probably 10 or 12 years ago, I dealt with an accounting firm, and the rule of thumb was the business was worth the annual revenues, annual billings. If the CPA firm billed out $500,000 a year, that's probably what the CPA practice was worth. Now, there would be conditions that would have to apply to that. I don't think anybody's going to come in and write a check for $500,000, because think about if you are the CPA and you've sold, all of your clients, they like you. They've done business with you for a number of years, and if you're out of the picture, they may not like the new CPA that acquired the business. So revenues can drop. So, we as evaluators, we do look at the condition of transaction. In that particular case, there would be probably an earn-out or a residual payment made over years based on client retention. So professional practices can be valued, and as I said, there are, in fact, I had a conversation last week with a gentleman. All he does is veterinarians. He values them coast to coast. Yes, they do have some tangible assets, but I would consider that a professional practice in part. But CPAs, attorneys, they don't own much equipment, obviously, so it's that customer base, it's that client list that they have that does have value. And we use the income approach. We can use the market approach as our approaches to determining value. So yes, professional practices can certainly be appraised.
Awesome. I think that's about it for today's webinar. We do have some other questions which we'll be sure to send to Dan. Let us know if you have any other questions or comments. And thank you so much, Dan, for hanging out with us today.
Glad to do it. I've enjoyed the time together, and hopefully it's been beneficial for our audience. And as Laura said, I'd love your questions to come in via email, or she can pass them on to me. Phone calls are welcome as well. So thank you for the opportunity to talk with you today, and I look forward to meeting you in person one day. Thank you.
Thank you, everybody.